Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and it is February 12th, 2025. It's another Wednesday, live at 5 Eastern on YouTube here. And we're delighted to bring back to the show Will Rhind from GraniteShares. How you doing, Will?
Doing well, Justin. Yeah, all good. Thank you.
Good. And so, of course, last time we had you on, Will, it was really interesting because we were talking about these single stock ETFs, how you use leverage and inverse, and it was kind of a newer product at the time, and now I feel like now it's old hat almost. It seems like it's really, this space has exploded. There's a lot more offerings, with a lot more stocks in a lot of different ways. So again, if you want a little bit inverse, if you want a lot inverse, if you want leverage, there's all sorts of different levels. So maybe as we get just right into it, talk a little bit about what kind of took off with these single stock ETFs.
Yeah, so I think like any new product and new concept really within the industry, sometimes it takes a while to catch fire, so to speak. And this is no different really with the single stock. So the good news was that leveraged ETFs more broadly are really popular, but leveraged single stocks were a new type of leveraged ETF that people hadn't seen before. And so when we brought those to the market, it did take a little bit of time for people to appreciate the new nature of these products. And so I think the big sort of light bulb moment really was when we launched the 2x Nvidia ETF, which was NVDL, and it wasn't a smash hit immediately, but we did launch it just a couple of months before the release of ChatGPT. And of course, when ChatGPT came out, that was really the sort of the starting pistol was fired really in terms of not just everyone's interest in AI, but in also the levered single stock business as well. And so NVDL is now the largest leveraged single stock ETF in the world. GraniteShares is the largest provider by AUM of leveraged single stocks in the world. But the category's just taken off, and like you said, Justin, that's meant not just GraniteShares, but other companies coming in with products, and this category's expanded to really offer a huge amount of offerings, both on the long levered side and short or inverse side as well.
Yeah, and I guess that's one of the things that I appreciate. I do deal with mostly cash accounts, Roth IRAs. I love trading in those vehicles, and you can't short, right? That's just not allowed in those vehicles. Now you've got the option of using some of these inverse ETFs to take a short position in things, it's nice to have another way of doing it. Sure, I could do the options and stuff like that. I have that ability in my IRAs, but this kind of gives me another way of doing it. But as with any leveraged or inverse product, we have to kind of give those disclaimers, right, of the things that people need to know, and two things that always stick out when you're looking at like an SQQQ, how bad the contango can be on something like this, where because you're using derivatives, the expiration and everything like that. So can you talk about kind of what your warning is for people if they're maybe new to investing, and maybe some of these leveraged products aren't exactly the place to start, as exciting as they can be sometimes?
Yeah, no, that's right. So I mean, that's just common sense really, that if you're new to investing, then definitely leveraged ETFs are not the place to start. This is a sophisticated product for sophisticated investors. Typically, these are people that in the retail world or in the self-directed world are already permissioned for active trading. And those people are graduating, if you want to say that, from other forms of leveraged investing, be it in futures accounts, be it on options, or even just leverage through margin accounts, and are kind of moving to the ETF world because it's a lot more efficient and a lot more cost effective. But yeah, first and foremost, clearly this is a sophisticated product with sophisticated people. And then, with leverage, it's the old risk and reward, that you don't get twice the reward or the potential for two times the return without two times the risk. So, when you have anything that's leveraged, you have the potential for amplified gains. But guess what? If it goes against you, you also have the potential for amplified losses. So that goes without saying. And then to your point in terms of the
maybe goes without saying, but worth repeating.
yeah, no, absolutely. It's the
common sense part.
Common sense part of using anything that's leveraged. That's fine on the upside, if it goes in your favor, but if it goes against you, there's amplified losses.
Yeah.
And the last part, I think, which you kind of highlighted was, or is, I should say, the tracking performance or the return performance of these products. And they are designed to be daily leveraged products, which means the investment objective for us and for other competitors is almost always to track the daily price, meaning if it's two times leveraged, it's two times the daily return of Nvidia, of Tesla, or whatever it may be, or if it's inverse, the exact opposite. Mm-hmm. And that's important because that's how we maintain constant leverage. In other words, if you see a product that's labeled two times leverage or 2x, regardless of whether you buy it today, whether you buy it in 3 months' time or 6 months' time, you're going to get two times leverage for that given day. And that's what's referred to as constant leverage. So the way that we achieve that is we rebalance the portfolio at the end of each trading day. And so what that means is it introduces a non-linear return over longer periods of time. In other words, because the investor doesn't have the impact of margin and doesn't have to face margin calls, that's all taken care of by the fund, that over periods of time, if you're looking at the difference between a levered single stock ETF like NVDL, for example, against the price of Nvidia, you're comparing, on the one hand, a linear return, the price of Nvidia, versus a non-linear return, which is the ETF. And that's why we suggest that for people using these products, they hold them for a short period of time or a shorter period of time. In other words, the longer you hold it, the more chance that the return will deviate from that linear return. Now, that's exactly by design. The product is doing exactly what it says. It's just that people sometimes in their mind might think, oh, it's two times the return of Nvidia to infinity. So meaning that if I hold it for 5 years, at the end of 5 years, I'll have two times the return of what Nvidia did. No, that's not what it does. It does it for one day, rebalances, does it for the next day, the next day, the next day. But that introduces what we call a path dependency, which may or may not mean that you meet or get close to that two times leverage over a long period of time.
Yeah, I'm really glad you said that, because again, that's something that a lot of people don't understand at first when they're looking at these, and they are sometimes surprised. Wait a minute, I held it for this long. Why was that discrepancy there? But as you said, it's by design to achieve the goal of the daily, and
the daily leverage without margin. That's the big selling point.
Right, exactly. And so let's talk a little bit about another issue. And I always think of Volmageddon, what was called Volmageddon back in 2018. Was it January or February of 2018, where a lot of these volatility products, using leveraged on the VIX and volatility products was really in vogue. And, it was going great for a lot of people until, boom, these things like exploded. And some of them just completely were gone. A friend of mine, he was like, oh, I had it one day and then I couldn't trade it at all. It was like just blew up. So how does that happen? And is there any risk of that with these single stocks?
Yeah, so that happens, like with any fund where the fund is unable to meet whatever investment objective it has. It's just sometimes I think that, typically that's an environment where the fund does something that is unexpected. So in the case of the Volmageddon, these were ETFs that were sellers of volatility. And that seemed like a great strategy in an environment where volatility was flat, if not declining. And so there was a track record whereby people were sort of extrapolating that and saying, hey, this is always going to be the scenario. And of course, when volatility spiked and you were a seller of volatility, the trade went completely against you, and therefore the fund lost all of its assets and closed. Just like the people that owned oil ETFs in 2020. Who could have imagined necessarily that the price of oil would go to zero and briefly went negative? So
Right.
again, these funds are just doing what they're designed to do, but it's very unusual to have a major asset like that go to zero. So with these ETFs, the single stocks specifically, the worst case scenario is if you're 2 times leveraged. Think about that. That means that the worst case scenario is the underlying stock has to drop by 50% or more in a day.
Yeah.
So remember, these are daily leveraged products. They rebalance at the end of each day. But in that trading day, if you imagine a scenario where the price of Nvidia was to fall by 50% or more, you're 2 times leveraged. That means you're at 100% plus, and therefore the fund loses all of its assets. So again, that would be completely by design. That is what the fund is designed to do. Obviously horrible for anybody holding it, and for us, as the manager, we don't want that situation. But it's not to say that that couldn't happen. That is the worst case scenario.
Yeah. And with earnings, again, we've talked a lot on our shows about how when regulation fair disclosure came out, it seemed to bring a little bit more of a surprise with earnings. And so sometimes you have these very violent moves to the upside or downside. It could go either way. Is that something where you have any kind of caution? And look, for a while there, I would have found it very hard to believe that you could see some of these trillion-dollar companies move as much as they have. But I mean, that's the situation we're in. 20%, 30% move sometimes for a trillion-dollar company seems unfathomable, but it happens sometimes on these earnings announcements. So is there anything to kind of like, if 50% is kind of that limit, is there anything to kind of take from that as a warning?
Well, I think I wouldn't necessarily view it so much as a warning as much as it is just a statement of fact around, how markets are performing. And I think, after several years of a bull market, what you're seeing in those instances is a heightened sensitivity around earnings because, if we're at all-time high or close to all-time highs in the market, for the market to go higher, I think the market is calling for, ever higher expectations around company earnings. And if companies don't deliver, or even as we've seen from plenty of the major, tech companies or the Mag 7 companies, if you just miss slightly or have a forward guidance that doesn't quite meet the expectations, you can sell off. Now, that causes the volatility. And of course, if you have, if you're playing that with leveraged ETFs, then of course that will be outsized returns or losses. But I would sort of say that there's the pro and the con. That the vast majority of people, I think, that use these products, that's what they want. In other words,
Right.
they're attracted to the volatility. They want to see big moves. And therefore, particularly to trade around earnings, is exactly what people are looking for, because people in some cases have kind of been disenfranchised a little bit through options because you're not able to trade in the pre-market, you're not able to trade post-market. That a lot of times, even if you get directionally the option right, the amount of premium that you're paying because of the implied volatility in some of these names is so high that you still lose money. So people are sort of moving away from those, and certainly a lot of our customers tell us, into levered ETFs where they can be active in the pre-market, active in the post-market, where they can get in and out of the stock without paying these crazy premiums that you see in the options market. So I think, again, people are just looking for these bigger moves. It's just a different mentality that traders have versus long-term investors. And when it comes to earnings seasons, we see definitely a heightened level of trading volume in the products, which goes to show that you get heightened awareness and engagement in that period because people are bullish or bearish on certain stocks and looking to use our levered single stock ETFs to play that.
Yeah, no, it's a great point. I mean, if they didn't, if they weren't attracted to it, they would just go with the stock itself. But there's
Yeah,
a
or just not participate at all.
right. Yeah.
So it's definitely, that's the attraction, is for people that are really passionate about
Mhm.
trading, and follow these stocks very, very carefully, and are very active around the earnings season.
Mhm. I want to shift gears a little bit and talk about, because again, I feel like last time you were on the show, we got to spend some time on this, and it was relatively new. But you've got some new stuff out, and I think that's a little interesting. So talk to me a little bit about the Yield Boost product. Well, and kind of maybe put it in the terms of how many single stock ETFs you have now versus just a year ago, and now where you're going next with these yield boost ETFs.
Yeah, so on the levered single stock side, we have 20 funds today. We'll be
Mhm.
launching actually three more this week. So it takes us 23 levered single stocks, both long and short.
Mhm.
Yield Boost is a new family of ETFs that we launched the first one just at the end of December, kind of before Christmas time. And that's another sort of spin off of the single stock ETF play. So we recognize that there's a market for leverage on single companies, but there's also a market for income or yield on single companies as well. So what Yield Boost is about is trying to create a high level of yield by selling options, in our case, put options on actual levered single stock ETFs in the case of Tesla, to
Mhm.
generate that high yield, but also offer some downside protection because the options that we're selling are out of the money, which means they have less of a likelihood to be exercised. So Yield Boost is a new concept. It will be not just single stocks, but it will be indices as well. The TSYY, which is our first offering, that's on Tesla. That is the first of a potential family of 20 funds. And again, really looking to capture the market for income right now, or for yield, which is also a really big market as people try and look to replace traditional forms of income or yield in the portfolio, mainly fixed income.
Mhm. So, and it's funny because when we were talking in the pre-show, I made the assumption that it was, because usually when you say yield, I usually
Yeah.
think, oh, covered calls, and you talked a little bit about it. It's that downside protection using puts. So can you kind of walk us through the mechanics? Because I think of, when I think of the protective puts or call writing, the two things, it's always a matter of how far out do you go with your
Yeah.
expiration, and how do you choose your strike? So, what do you guys have a formula that you use, or what are you doing there?
Yeah, so I think with covered calls, there's a lot of strategies in the market that use the covered call strategy, and the covered calls, people just need to be aware that when you sell that call option, the majority of these products do that at the money, which means that
Hmm.
there's a 50% chance of being exercised. Well, so the upside's capped, so you receive the premium, but your downside is not protected at all.
Hmm.
And I think that one sort of cautionary tale with covered calls, as we've seen, is that doing covered calls on growth stocks is challenging because clearly those products or those underlying stocks move up over time.
Hmm.
And where we've seen covered calls and growth stocks have typically been able to produce quite good yields, but that's come at by sacrificing the principal. In other words, your NAV has been eroded, and there's big issues with NAV erosion. So Yield Boost tries to solve that problem by combining the selling the puts. In our case, like I said, I mentioned, it's out of the money, typically one standard deviation. So your chances of being exercised go from 50% all the way down to 15.8%. So you have a much smaller chance of being exercised. Therefore, that gives you downside protection.
Hmm.
And that's really what we're trying to do, is solve for the NAV erosion problem by still giving people high levels of yield, but again, trying to protect some of that downside so you don't just get your principal eroded over time. And that's really the yield boost philosophy, of which I think TSYY is a good, so far, a good demonstration of the power of that sort of philosophy.
hmm And I'm going to show real quickly, just kind of, and this comes from your GraniteShares website. So, is this right? Distribution yield of 35.11%. So
That's right. So we paid the first distribution at the end of January. So if you take that distribution and annualize it, that yield is 35.1%. And at a time when the underlying Tesla stock was falling and has been falling since the inception of the product. So yeah, generating a nice yield. The market, S&P 500 returned 20% last year. So if we keep up this kind of performance, that's a very nice level of return that comes from the strategy.
Yeah. And so, how often are these distributions? Are they on a set schedule? Monthly,
Yes.
quarterly?
Monthly payers. So we have another income ETF. It's not use options, but HIPS, which we've probably talked about before briefly, but it's a monthly payer just like that.
Yeah. And so, just to kind of put this in a different, bucket, and I should warn folks that if you do pull out, using a market search chart, for instance, one of the problems with a product like this, if you look at just a regular price chart, the distribution comes out and it makes it look like the stock got hit. I'm just going to show a quick market search chart, and I want to make sure that people are very aware that you have to make an adjustment. So here's TSYY, and yes, Tesla has come down, but you see this huge drop on this day. You see this, this is maybe real, but this one was a distribution. So you have to kind of back that out and adjust for it. So that's something that you can't really use a comparison chart of, oh, let's compare this versus this, unless you're looking at a total return. And you were kind enough to bring us one from Bloomberg, so I'll just show that real quick. And this shows the white on the top is your yield boost, so that's TSYY. Then we've got a yield max and Tesla itself, this lower part. So again, kind of walk us through the chart and what we're looking at here.
Yeah, so here you see the total return performance of 3 different trades. So there's the yield boost since inception on the top, and then you have the 2 at the bottom, which is the stock price of Tesla, the company, and another ETF, in this case a popular ETF on Tesla covered call strategy. So you can see the difference really between the two. And the point here is that on a total return basis, that you see the yield boost product has maintained its value, total return of 4%, which includes obviously the distribution since inception, versus a market where the price of Tesla dropped fairly significantly, over 24% in this time. So kind of trying to demonstrate the value of that downside protection strategy while still giving that high level of income that we talked about.
Yeah. So again, this is kind of a newer product, so I feel like we have to kind of, maybe if you could walk us through a few different scenarios, because you show me this and I'm like, oh, well, this is awesome. Tesla went down this much and you didn't. You maintained the value and even got a little bit of a performance above the zero line. Where would you expect this to kind of, what should investors be aware of like, oh, be careful of these situations where it's going to be a little bit negatively affected?
I think, again, it's about the downside. So when you sell a put, when you sell an option of any kind, you're receiving premium. And that premium is the income you're paying out. So your upside is capped at that point. So regardless of whether you buy a put right, such strategy, or a covered call, the payoff is identical. So you're capping your upside. So therefore, you're just trying to limit your downside at that point. And therefore, your downside is just about the performance of the underlying versus the exercise price of the option. And so what any kind of strategy, what any of these don't like is clearly when the underlying moves down a lot. and through the exercise price. And so that's how you can get these downward, downdraft movements. So that's clearly the risk with anything. So your ideal scenario is like if you imagine a scenario where it's almost like an insurance company, where let's say you're a car insurance company, and in this case you're writing car insurance, you're receiving the premium. So clearly the scenario that you want is for everybody to drive around their cars and not have any claims or not have any accidents. And that way you just collect 100% of the premium and there's no payout. And then you go for this the scenarios of, okay, well, if someone has an accident, but the accident's not that bad and it's not more than the premium that you receive, then you're still winning because of that. But then you have the catastrophic scenario where everybody crashes their car on the same day and you don't have enough to cover it. So you got to talk about the crash scenarios in the underlyings, where the price would crater like such an incredible amount in a day that your performance would be highly correlated to that, and lose a considerable amount of your assets.
Great. One of the questions, I'm looking at some of the YouTube comments. One of the questions coming from there is from Barry, and he's asking about for these yield boost products, since you've got this, distribution that's coming, is there a way to just automatically have that distribution reinvested back in? Is that something that you offer, or is something through your broker?
Well, this is a great question, because this goes to like sometimes I call it the blessings and the curses of ETF issuance, in that as an ETF issuer, we manage the fund. And so we're responsible for the performance of the fund. It's our fund. We create it, we issue it, but then we list it on the stock exchange. And sort of from that point, we're disintermediated from the point of sale and therefore ultimately our customer. So the way you buy an ETF is through a broker. It's not through us. So therefore, any kind of reinvestment plan, has to therefore be offered by the broker. It's not something that's offered by us directly. So a question for your broker is, do they offer reinvestment plans? Most do, but that would be definitely something to talk about with them.
Perfect. And since we did this last time, let's talk about, okay, you've got Tesla out there. Can you share at all some of the plans that you have going forward for some of these other yield boost products?
Yeah, so the family will be a mix of single stocks. So Tesla, Nvidia, Coinbase, some of the greatest hits of the levered single stock world. And then also on the index side, so baskets, targeted baskets, broad baskets in the form of indexes, linked to the Nasdaq, linked to SPY, the Russell, etc., and even to Bitcoin. So huge different array of products, but ranging from very targeted to single stocks and Bitcoin to much more diversified in terms of broad index exposure.
Great. I think I've covered all the questions that I had. So is there anything I missed before we kind of go to the current market? Anything that you're like, oh, you know what? People really need to know this on either the single stock leveraged and inverse or the yield boost. A final thought on those.
I think we covered the basics. But again, with anybody, if anyone was watching it and has more questions, please feel free to reach out directly.
Perfect. And I should have mentioned that at a few places where people might kind of follow along what's going on, at GraniteShares on X or at Will Rhind. That's RHIND for following on X. Do you ever do like videos or anything like that on your on X? Some instructional product.
We do. We have our own YouTube sort of podcast ourselves. So the High Conviction podcast on YouTube. So if you just look up GraniteShares. And I think while we focus more on just pure educational content, typically about markets, we'll start to do more educational stuff around products as well where appropriate. But for now, we do a lot of content on X. We have a Substack as well, GraniteShares Substack, where we post a lot of good stuff. So different ways people can consume what we're putting out.
Yeah, perfect. Okay, let's kind of shift gears again, and we'll go to the current market, and we're going to be kind of putting some of these products in the context of how you might use them in the current market. But I wanted to just kind of bring up the Nasdaq to start and get your thoughts on a few things, because certainly one of the things that sticks out on this chart is the ugliness of December 18th. And that, of course, was the Fed reaction. And it really kind of seems like we've had a little bit of a chop fest, something that we were talking about on one of our shows, IBD Live, this morning, where it just is a lot of back and forth, which I know for leveraged ETFs, whatever, that's kind of like your worst case scenario, because that's where you can really kind of lose that. You're tracking it on the daily, but you can really kind of lose that value long
Yeah,
term.
that's right. If you're a long-term holder, but obviously for short-term, it's an environment
Right.
that people love because it's up and down, and that's what people are looking for.
Yeah, yeah. So again, just again that warning that if if you've been holding over this period, your results will be very different than if you were just one day at a time kind of person. Which, again, as you said, by design. But maybe put this in the context of some of these economic reports. I mean, it seemed like after our 50 basis point cut in September by the Fed, it seemed like people were a little bit more lax on our economic reports. The CPI, jobs, it was kind of like not as big a deal. And then December 18th happened. Now it seems like everyone's focused on every CPI report, every jobs report. We just had a CPI report today. We have a PPI report tomorrow, jobless claims tomorrow. And it just seems like all this is a little bit more in focus. We had Powell speaking the last couple days, and I mean, you look at the 10-year Treasury yield, and I mean, this was quite a day for the 10-year Treasury yield. So, is this kind of environment? What would you say about it? How would you characterize it?
I think the environment is a little bit volatile,
Hmm.
and specifically, the market, I think, is looking for some clearer direction around the policies of the new administration specifically. So, the talk of tariffs, the talk of the different things, having tariffs being put on, having them being put on pause, is just causing some volatility. Now, specifically today, obviously we had a CPI number that came in hotter than expected, which caused the market to sell off.
Hmm.
Now, if you remember, we had a very similar thing happen last year, where we came out of the gates with a hot CPI print that then caused some volatility in the market, recalibrated expectations around the Fed, cutting rates. So I think that there's a lot of anomalies in this report, and to me, while kind of interesting to look at it, or like a little bit disappointing perhaps, I think it's more noise than anything. And we shouldn't take this one number to mean that much at this time. And again, I go back to last year, where there's a lot of anomalies coming off of the end of the prior year and the beginning of a new year.
Hmm.
So I didn't really see anything in that report which would tell me that there's a big inflation problem, or inflation starting to be a problem. So for me, more noise, but it just shows, I think, that we are sensitive as a market right now to almost any negative data point. And like I said, I mentioned earlier, we've seen that with the company earnings, where all things being equal, the company delivers an amazing set of results. But if the guidance is slightly below, where market is expecting, even just for one particular product, service, part of the business, then that can sort of knock the stock quite a bit. But it typically tends to be the case that stocks have bounced back from that because earnings have been resilient.
Hmm. And let's chat a little bit about the small caps, because a lot of
Yeah.
times when you talk about 10-year Treasury yield rising, that does tend to hit small caps a little bit harder. And the Russell 2000, for as many times as I thought, it was
So many
poised
head
and ready to
fakes.
go, it's Lucy with the football, all over again. And it feels like that's kind of the case again. So, when do you think small caps will have their day again?
Look, it comes back to the point I was trying to make on interest rates and policy, and certainly inflation, which is there has to be a bit more certainty around policy and around the direction of travel for interest rates and inflation. So we had that. You remember when people started to get really bullish around small caps last year, and it felt like inflation was dropping like a stone, and the interest rates were also going to come down by an order of magnitude. And then, like you said, when those expectations started to all be rolled back, particularly on the interest rate side, at the end of last year, then small caps sold off, and they're selling off again. Remember that 30% roughly of the companies in the Russell are not profitable. And so they're very sensitive to movements in interest rates and inflation. Again, a lot of these businesses will be sensitive to tariffs potentially. So the environment just has to be a bit more solid than it is. And again, if we are in an environment where interest rates are going to stay higher for longer, again, that's not good for anybody that's carrying a lot of debt. And so the market will switch back to what it's done before, which is prioritize the Mag 7, as one example of companies that are really sort of separated from the whole debt argument and trade on their own massive, cash flow generative companies that, really is sort of completely removed from the whole debt argument and interest rate. They're not interest rate sensitive really either.
Mm-hmm. Right. Another aspect here that is probably worth talking about is gold. And GraniteShares has BAR, BAR, as a ticker symbol, that kind of tracks gold. And this is the way that gold has been acting. It's and I do have a position myself in gold. How do you think this is useful for people right now to think of gold? It can be certainly a volatile instrument, and you always have your gold bugs and your gold bears, the people that won't touch it. But what's kind of your take on where gold stands right now?
I think gold has been sending a warning for quite some time now. So remember that for those of us in the kind of gold industry, when gold went through 2000, that was seen as a massive number, for the gold market. And now to think that we're knocking on the door of 3,000 an ounce, with interest rates as high as they are on a relative basis, is sort of would be almost inconceivable a few years ago. So what's changed? I think that gold is feeding off a lot of the sensitivities that we're seeing in the equity market and the fixed income market. In other words, the uncertainty, the more that stocks tick higher, is certainly feeding into the gold market. The debt and deficit situation, which is a big part of the tariff conversation, is a big part of the uncertainty, again, feeding the gold trade. And particularly this idea that while the US is certainly going to attempt to make some progress on the debt and the deficit situation, with what Musk is doing with Doge as one example, there's a lot of major countries in the world that are really in a tough spot with debt and deficits and don't seem to be really going in the right direction, or are perhaps even unable to go in the right direction. And so gold has become that hedge against these kind of problems. And I would sort of say that in the same breath, you're starting to hear more and more Bitcoin being mentioned. But this idea of an asset that's not correlated to the stock market, to the bond market, to government debt, other issues that are really sort of plaguing the business cycle and ordinary stock and bond investors, you're starting to see more traction, I think, from people saying, hey, what's the value of just holding a percentage of my portfolio that, in the case of gold, will never go bankrupt, something that doesn't have credit and counterparty risk, it's just a lump of metal, doesn't have a correlation longer term to the stock or bond market. And I think you're starting to see that in terms of the premium that people are finding in gold.
Mm-hmm. So speaking of correlations, this kind of brings up another point that, with a lot of the stocks that you have your leveraged single stock ETFs on, a lot of them are the ones that are foremost on a lot of people's minds, and I would imagine the correlation among some of these stocks could be fairly high. So I guess when you have something like what we had on the 27th, where DeepSeek comes out, and everything AI just gets whacked in one foul swoop. Maybe talk a little bit about how to weather those kind of storms if you are playing the leveraged ETF side.
Well, that's where I think that people love these products. So on the one hand, you had the biggest one-day drop, for Nvidia, down 16, 17% at one point at the low. So 30% give or take if you were in the 2x levered Nvidia fund. There's a huge drop in one day. We saw people coming in and buying the most aggressive we've ever seen in our company's history. We had over $1 billion worth of inflows that one day into the 2x Nvidia fund, into NVDL.
Into buying.
Yeah.
Yes, okay.
Just in that one fund in that day. So that shows you, I think, how engaged people are and how willing people are to buy the dip in the stocks that they love the most or have the highest conviction in. And, Nvidia has certainly been one of those stocks, if not the stock, I think, for those high conviction plays. And those days, on the one hand, you can say, clearly if you bought the top and you lost money, it's terrible. But a lot of people who are trading these products live for those days because those are the days when you get that volatility and people are looking for an exit point or an entry point, depending on what they're doing.
Mm-hmm. And then I know you also, when I've had you on before, you've kind of shared your thoughts on some other commodities and stuff. You kind of have a commodity basket, and I was telling you how much I appreciated you educating me on platinum versus palladium versus catalytic converters and all that stuff. So anything on the commodity side that we should be? I feel like commodities have been they were very very top of mind on some of your past appearances because we were in more of a downturn for a lot of stocks. But is that are people still looking at particular areas of commodities in your mind?
I'd say, honestly speaking, Justin, not as much as you might think. And the reason for that is because commodities have been in a down cycle for a couple of years now. So if you want to talk about a value play in the market, then I would argue that perhaps the number one value play right now is in commodities, not including gold, of course, which is trading at all-time highs, the pro-cyclical commodities. So oil, particularly energy, metals, agricultural commodities. As everybody probably knows, Warren Buffett has continued to buy, shares in Occidental Petroleum, of course, in this particular environment. So I think if you're looking at something that's kind of depressed and has been sort of bombed out versus everything else, Bitcoin's at all-time highs, gold's at all-time highs, stocks are at all-time highs, then commodities are certainly worth consideration. So absolutely, it's something that I think people should be paying attention to, but not on the majority of people's radar at the moment as they focus on momentum chasing in Bitcoin or in stocks or other parts of the market.
Mm-hmm. A few other. I'm again looking at some of the comments on the YouTube channel right now, and some folks were asking about the Palantir. Palantir.
Oh my goodness.
Yeah. So they were talking about the return. They're like, wait a minute, is this right? Are we looking at this right?
And certainly the best performing ETF we've ever launched in terms of return over that period.
Yeah, and I do have to disclose, I do have a position in Palantir. I wasn't brave enough to go with the leveraged myself. Just Palantir was volatile enough for me. So, but yeah, talk about that. I mean, what a move here.
What a move! What a company! So we started at $25. So the performance that people are looking at is absolutely real. That went from $25 when we launched back in September to now, as you're seeing on there, 289. Are you showing? Yeah, 289. Yeah. I mean, unbelievable. And when we launched, probably about sometime like 2 or 3 weeks after we launched, they announced they were going to go into the S&P 500. So there was a
Mhm.
big lift on that news. Then, not too long after that, there was an announcement they were going to move the listing from the New York Stock Exchange to NASDAQ, so they could be eligible for the NASDAQ 100, the triple Qs. So there was a big
Mhm.
lift from that as well. And as you know, the results have been stellar. The Q4 earnings that just came out, they absolutely smashed it again. And the stock's just been on a tear. I think it's one of these ones where the retail zeitgeist is alive and kicking. You know, retail investors love this stock, and those that follow it have been very passionate about it for a long time. We have a business in Europe where it's a bit older than what we have here. So we've had a Palantir ETF in Europe for a number of years, and it's a company that might be not known to everybody in the same way that perhaps now Nvidia is, but for
Mhm.
those that know, they know, and they've been buying, and
And as you
the
said,
performance has been amazing.
the passion is high.
Passion, yeah, the passion. If you look on X, a lot of commentary. I mean, it's not just Palantir, of course. There are plenty of companies, but there's a lot of people very passionate about the company, its prospects, and particularly, it's an AI darling, of course, just like so many of the stocks. But yeah, one of these exciting companies that has just been on an amazing ride.
Hmm. Yeah, absolutely. And just for comparison purposes, I'm gonna put the non-leveraged version here again. A very nice move. I'm gonna switch to the weekly chart here. Especially if you just go back, 2 years, the move it's had off the bottom, it was certainly under the weather for a little bit, as most things were in 2021. So yeah, a
Yeah.
very very impressive move. And well, Will, any final thoughts? Because again, I really learned a lot. The protective put side is again something that we just had someone on a couple weeks ago, Matt Caruso, talking about using puts to hedge. It seems like there's a lot of ways, new ways for people to kind of protect their portfolios with some of these products, whether it's an inverse ETF, to protect some of their hedge going into earnings or something like that.
Yep.
There's just a lot of new ways of kind of doing portfolio construction. So yeah,
That's
right.
right.
Any final thoughts?
Yeah, I mean that's you hit the nail on the head. I mean these are the two biggest trends in investing right now: leverage and income, or leverage and yield.
Hmm.
And so whether it's on the back of the credible performance that we've seen just from the market more broadly, but from certain stocks in the AI space and the crypto space, people are trying to take advantage of the momentum there, and then also on the yield side that, with the advancements and the improvements in liquidity on the options side and the proliferation of options contracts themselves on all sorts of new stocks and products, we're seeing a lot more opportunity in the option space to deliver income. And again, that's replacing a lot of traditional fixed income strategies where people have been burnt with bonds in this bond bear market.
Yeah. Well, thank you so much for coming on again. Again, I think it's really exciting to have some of these innovations and to kind of hear about it so early in the process. We'll definitely be keeping our eye on the yield boost stuff. And as a reminder, folks can look at X, both at Will Rhind, WILLRHIND, and at GraniteShares for more information. And plus, you mentioned the YouTube videos that you
Yep,
produce.
YouTube channel and Substack as well. So
And
follow us
Substack.
on both of those.
Yeah, so awesome. Thank you so much for coming on the show.
Thank you, Justin. Absolute pleasure. Thank you.
Okay. That's going to wrap it up for us this week. Thank you so much for joining us. And next week, we're going to have Harold Morris on the show. He, of course, is one of our senior product coaches. He likes to go, he's kind of our options expert. He does a lot of options, a lot of spread trades. So we'll talk a little bit about some of those trades that he is doing, how he chooses his strikes, how he chooses his expiration dates and everything like that. I'm actually going to be doing it remotely. I'm going to be doing it from Las Vegas, probably doing it from my hotel, since I will be at the Las Vegas Money Show. So if any of you are going to be in Las Vegas for that money show, I hope you come by and see me. I'm going to be giving a talk on Monday, but I'll be at the booth here and there as I'm wandering around, kind of checking out what other people are doing and saying hi to of folks, some of the podcast guests that we've had. So again, I hope that if you're in Las Vegas for the Money Show, that you come by and say hi. So that's going to be it for us. We'll see you next time. Take care.